Getting paid every month plus the stress-free strategy of an ETF, what could be better? There are more than 800 monthly dividend funds, with more than 600 of those underperforming the market. How can you possibly find the perfect fit for your portfolio? In this video, I'll show you a new ETF screener for monthly dividend funds that will narrow your list to only the very best. Then I'll reveal the top 7 monthly dividend ETFs with a mix of returns, dividends, and diversification. Hey Bowtie Nation, Joseph Hogue here with the Let's Talk Money channel and two of the most popular topics in today's video, monthly dividends and ETF investing. Combine the two and what's not to love? Dividends account for nearly half the total return on stocks, and who doesn't like getting paid to invest? And exchange-traded funds, they just make investing so much easier and stress-free. But as is so often the case in investing, it's not for the lack of options, it's having too many options and how to find the best stocks or funds for your portfolio. So in this video, I'm going to be using a new ETF screener on StockCard to show you how to combine these two topics to find the perfect monthly dividend ETF for your portfolio. I'll leave a link to StockCard in the video description below. Click through and then go to Portfolios in the top menu. You'll find the Bowtie Nation portfolio in the Stock Picks section. It's free to follow and you'll get email notifications whenever I buy or sell from the portfolio. And as a special bonus, I've negotiated an exclusive discount for all you out there in the community. Use the promo code BowtieNation, all one word in lowercase, for an exclusive discount beyond the free trial. We're getting started, but first, you know I gotta send that special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. And this new ETF screener is a perfect place to start, narrowing down your list of funds to find the perfect fit for your portfolio. You can toggle back and forth here between the stocks and fund screener and then select your filters below. Since we're only looking for monthly dividend ETFs, we'll start by filtering for those, and at any time you can click apply to see how many funds meet the criteria. And here we see we have 866 ETFs paying out monthly dividends, so we want to click back into edit and narrow that list. This first filter I'll use is for passive ETFs, which generally tend to have those lower expense ratios. Now that's not saying actively managed funds can't justify their higher fees with those better returns, but I want to stick with these low-cost funds here. I also want to filter only for funds with assets over $50 million, and there's a reason here that most investors just don't understand. You see, a fund isn't usually profitable for the provider until it reaches about $30 million in assets. Now that's the point where the fees actually cover those fund costs. So what happens, and this is a big problem for ETF investors, is that if you're investing in some of these smaller funds, then you run the risk of that fund shutting down after just a few years. Now that doesn't mean you lose your investment. At that point, the fund liquidates and sends a check out to investors, but may also mean owing capital gains tax on that sale. Beyond those two criteria though, we'll also filter for those ETFs with at least 5 years of history, a track record to make sure the fund works. And finally, I'm going to filter for funds paying a 3 to a 10% dividend yield and click apply. And we see just those 5 criteria have narrowed our list of monthly ETFs to 63 funds that we can then look at more closely to pick our top 7. Of course, feel free to play around with the filters, narrow the list more or less, but I'm going to use these to find those best ETFs. The Invesco S&P 500 High Dividend Low Volatility ETF, ticker SPHD, is a favorite among investors and pays a 3.9% yield. This is a great dividend stock ETF because it combines that search for the higher yields along with a lower risk profile in those with lower volatility. Now, the fund invests in 50 stocks of U.S. companies with high dividend yields that have also historically been safer than others. It's a little more concentrated in a few sectors, including real estate, utilities, and financials and consumer staples, but those just tend to be the less volatile ones and economically sensitive. Now, dividends have held up surprisingly well on this one, probably due to the fact that these companies are a little less sensitive to the economy. The dividend payment has increased more than 50% over the last 5 years, from about 10 cents a share to 15 cents each month. And the expense ratio is also lower on this one, with just 0.3%. And because it's a stock ETF, there's also some of that upside price potential on the shares besides that dividend. This next fund, the Spider Bloomberg Barclays Convertible Securities ETF, ticker CWB, has the lowest dividend yield at just 2.2%, but I wanted to include it here because it also has one of the best for total return potential. Look at this chart here of the shares over the past 2 years, a 65% return, well over the 50% return on stocks in the S&P 500. Now the trick is here, the fund invests in corporate bonds with an average coupon of 2.5%, and that's where it gets that dividend return on it. But these bonds are also convertible into shares of stock if the stock price increases. Now that means investors get all the safety and the cash flow of those bonds, but the upside potential on those stocks. The fund holds 243 bonds across mostly industrial, utility, and financial sectors, with the biggest holdings including Tesla, Wells Fargo, and Carnival. Now, the dividend payment has come down a little on this one. As interest rates decrease, the share price takes off and bonds just yield less, but that total return still makes for a great addition, and the expense ratio of just 0.4% is still pretty cheap. And now this brings up an important point I wanted to make, that you shouldn't just focus on those stock funds for your portfolio. Now, of course, pure stock ETFs are going to produce those higher returns when the market is going up, but over the long term, through many market cycles of crashes and recoveries, having a mix of these stock funds, bond funds, real estate funds, and then the hybrids like this convertible bond fund, they're going to give you that great balance between return and safety. This next monthly fund is also a favorite, the Global X Super Dividend ETF, ticker is SDIV. The fund holds 100 of the highest dividend-paying stocks globally and produces a 6.8% annual yield, which is more than 4 times the market average. Now, the expense ratio of 0.6% on this one is higher than most, but there's still a lot to like about this one. Now, the monthly dividend has come down a little as that share price has just jumped higher and companies haven't yet raised their dividends, but it's a well-diversified fund across different industries and internationally. I especially like the exposure to stocks from other countries, which is something that most investors don't get. The stocks in the fund sport a low 10.3 times on a price-to-earnings ratio, a factor of so many being from cheaper international companies. It's less than half the PE ratio on US stocks, so this is a good value play as well as for that dividend yield. The iShares Morningstar Multi-Asset Income Fund, ticker IYLD, is a really interesting opportunity, and not just for its 3.7% dividend yield. Now, instead of investing directly in stocks or bonds, this fund is a fund of fund. It holds 10 income funds across the asset classes. So you see here, it's got high yield bonds, international stocks, it invests in emerging markets and US Treasury bonds, as well as real estate and preferred shares. So the fund has a target of 60% in bonds, 20% in stocks, and then 20% in alternative income investments. It also holds about 45% of the portfolio in international assets, so strong diversification here. And the larger weighting in bonds gives it a higher level of safety, though it still holds enough in the other assets and sectors for a good total return. Now, the drawback on this one, though, is because it's that fund of funds, the expense ratio is going to be higher at 0.6% annually. You're essentially paying the expense ratios of all the funds in the portfolio plus the management to run this fund. So if you wanted a cheaper way to do this, you could just invest in the original funds in the same weightings and cut maybe 0.2% off your expenses. And now, looking at a few of these funds, it brings up a question that I wanted to get your feedback on. A few of these, the share price has run up so high that the dividend yield really isn't that impressive anymore, even if the total return has still been really good. So my question is, does dividend yield matter quite as much to you if you're getting that total high return? Now, let me know in the comments below. Would you rather see ETFs or stocks only with those higher yields, or with that mix of yield and price return? This next one is one we've highlighted before, the VanEck Vectors Fallen Angel High Yield Bond ETF, ticker ANGL. The fund invests in bonds that were issued with an investment grade rating, so a strong financial rating for the company, but have since been downgraded into high yield. Now, this can happen for a lot of reasons. Usually it's a slightly weakening financials of the company, or if the company adds more debt, but 93% of the bonds in this fund are in that first 2 risk ratings, just below investment grade, so still fairly safe investments. And what happens is when these fallen angels get downgraded, the price of the bonds comes down, but they're still paying that same coupon amount, so the interest rate is going to go up. Since they're still solid companies, the default rate is low, and this group of bonds has outperformed the broader high-yield index in 11 of the past 15 years. The fund itself has produced an 8.4% annualized return since 2012, which is really good for a bond fund, and it pays a 4.5% dividend yield. The expense ratio is just 0.4%, and again, these are bonds of good-sized companies like Sprint and Freeport-McMoRan. Almost 3/4 of the fund is in bonds of U.S. companies, with the rest in developed nations, and it's well diversified across sectors as well, with bonds from companies in 9 sectors. Our next dividend ETF is another hybrid, the Global X Super Income Preferred ETF, ticker SPFF, investing in preferred shares with the highest dividend yields. Now, a preferred share is somewhere between stocks and bonds. It's not a debt obligation like a bond, but it includes that fixed dividend payment that's higher than most stocks. Now, preferred shareholders get their dividend paid out before stockholders, so it's a little less risky, and most convert to a regular stock at a certain price. So preferred shares here don't have quite the upside return on stocks, but offer those higher yields and the safety of bonds. Now, the Global X Fund invests in 50 of the highest paying preferred shares and produces a 5.6% dividend yield against an expense ratio of just 0.6%, which is really good for one of these specialized specialized ETFs. The fund skews a little towards the financials and bank stocks because those just happen to be the ones that pay the highest yields on their preferred shares. You've got a lot of big bank names here like Wells Fargo, JP Morgan, with some of the smaller names like Ally Financial as well. The fund has actually produced a 13% total return over the last year, so there is some room for price appreciation besides just that dividend yield. The iShares Preferred and Income Securities ETF, ticker PFF, is a similar theme and pays a higher yield of 4.5%. So this is in that same preferred shares theme as the last fund, so you don't necessarily need both of these, but I wanted to highlight each to give you more options. It's a part of the market that most investors neglect, so it's just nice seeing a fund that gives you an easy, one-stop access. The PFF holds 512 preferred securities with an average price-to-earnings ratio of just 9.5 times, which, again, is about half the market average. The fund price also tends to be about half as volatile as the stock market, so definitely that idea of safety and cash flow. Now again, it's pretty heavily weighted to the financial sector with about 54% of the fund in banks, diversified financials, and insurance because, again, that's just the sector that issues these types of mostly preferred shares. Click on the video to the right to see how to create your own ETF, how to see the top stocks in any exchange-traded fund, and create your own super fund. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.